And we talked a little bit about free markets and free trade. One of the big things in the crisis of 2008 and thereafter is the question of free capital mobility and the question of the functioning of capital markets. I know in your book you write about the relationship between the stock market and corporate governance, and you talk about not all value is being represented when stockholder value is being represented.
That's right. Yeah, I mean, I once again try to kind of make my readers think about it more by putting it provocatively. I say companies should not be run in the interest of their owners. Now, a lot of people, I mean, find it shocking because, you know, we have been told, especially in the last 20, 30 years of finance-driven capitalism, that shareholders own the company. They have the long-term interest of the company in their mind. If you maximize value for the shareholders, I mean, it is good for the company, which is in turn good for the overall economy. But actually, you know, this proposition is that in a way at the root of our problem, because in modern liability, in modern limited liability companies with dispersed ownership, I mean, hundreds of thousands of shareholders, I mean, maybe sometimes even millions of shareholders, individual shareholders do not have an incentive to wait for the long-term result. You know, I mean, they, despite being the legal owners, paradoxically are the least committed to the long-term future of the company because they find it the easiest to leave. Yeah?
The liquid secondary market.
Exactly, yeah. So the other stakeholders in the companies are like the employees and the suppliers and the local community and the consumers and so on. You know, they find it more difficult to leave because, I mean, if you're a supplier to, I don't know, General Motors, and then suddenly you don't like that company, you want to start supplying Honda, I mean, they are not going to take you in like that, whereas shareholders can sell the shares at the, you know, the click of a mouse, so to speak. Yeah? So this is, especially with financial deregulation in the last 3 decades, this has given enormous power to the floating shareholders. I mean, these are the people who own tiny bits of the company with no long-term commitment. So much so that we have run, especially in this country and in the United Kingdom, we have run the companies basically in the name of shareholder value maximization, which basically involves not investing for the long term. Yeah? Because the easiest way to boost your profit is not to do anything that brings results 5, 10 years later. Yeah? So you don't invest in machinery, you don't invest in research and development, you don't invest in training, you just hold the cash, yeah, and then distribute a lot of that through dividends. You know, in the 1970s, only about 35 to 45% of American corporate profit was given out as dividends. These days, it's at over 60%. Yeah? So, I mean, the companies have less cash to invest, and then they cannot even use all of that for investment because now you have to do share buybacks to prop up share prices. And you know, share buybacks are accounted for only about 5% of American corporate profit in the 1980s. Today is, you know, often more than 100%. So actually, you are not using any of this profit for the long-term productivity development. You are just keeping it. So you can go. Yeah, you are just using it to keep the shareholders happy.
Yeah, so you can go buy your own private island.
Exactly.
Not worry about the future.
You know, I mean, I don't mind people buying 10 private islands if their productive contribution is big enough. You know? But I mean, these things have been done without actually doing anything for long-term future of the companies, and there lies the central problem.
What's the old saying in finance? IBG, UBG? I'll be gone, you'll be gone.
Well, you know, yeah.